Guys, with the latest jobs report that we just got a couple of days ago, we had a jobs disaster. Unemployment hit a 4-year high. This is what you got to do before it's too late. There were only 22,000 new non-farm jobs added last month. Guys, think about this for a second. That's an economy of over 330 million people barely moving forward. We've got some things to think about. And the Federal Reserve is still behind the curve. This is the moment that all of us need to pay attention before it's too late. Today's video is an update on what the job market data from the Bureau of Labor Statistics showed us just a couple of days ago. But more importantly, this video is about what we can be doing right now as consumers, as investors, as people that are looking to be better with our money in our own household. So we're not blindsided by the slowing of the job market and by a Federal Reserve that keeps having to play catch up. Now, here's the latest data. In August, the U.S. added only 22,000 non-farm jobs. That's a dramatic slowdown, guys. On top of that, the June numbers from 2 months previous were revised down to show an actual loss of 13,000 jobs. That's the first monthly contraction or loss that we've seen in more than 5 years. It was December 2020 when we ever saw a jobs report go backwards, right? And July's jobs report was revised slightly higher, but it's nowhere near enough to change the overall story that we're talking about. And the unemployment rate is now sitting at 4.3%. which is the highest unemployment rate that we've seen since 2021. Let me be clear about something though. A 4.3% unemployment rate is not the end of the world. It's still fairly low, but it's been lower than that for almost 4 years. So here's the real world impact. Major companies and manufacturing in tech and logistics and even in government contracting are all announcing layoffs right now, right? If you know somebody who's been impacted by layoffs recently, let me know in the comments below. It's real. It's happening. I know the numbers of 4.3% unemployment don't look bad, but there's something going on and brewing behind the scenes. And this jobs report, it sort of revealed it. So drop me a comment if you know anybody that's been affected. This community here is about information and it has to be about connection too. I want to hear from you. Now let me be clear about something else. When I say 22,000 new non-farm jobs were created, non-farm jobs means that it doesn't include farm workers, private household employees, people that work at nonprofit organizations. None of that is included in the 22,000 new non-farm jobs that were created. And they always use non-farm jobs because they feel like that's the broadest snapshot of how our labor market is really doing. Now, let me dig a little deeper into that unemployment number of 4.3%. The headline unemployment rate, what you hear on the news at 4.3%, again, being the highest that it's been in almost 4 years, here's the problem with that number. The 4.3% unemployment rate only counts people who are actively looking for work right now. That 4.3% unemployment rate, it doesn't include people who are working part-time that really want to work full-time jobs. It also doesn't include discouraged workers, right? People who stopped applying for new jobs, it doesn't include them either. And it certainly does not include the long-term unemployed people who have sort of just dropped off the radar altogether, right? So that 4.3% unemployment number can be misleading and a little bit deceptive. The truth is this. The broader unemployment measure is always going to be higher than just that unemployment rate. So the official numbers of unemployed usually understate the pain in the job market. So what we're seeing is likely worse than what they're reporting. Yeah, 4.3% unemployment rate is the highest in the last 4 years, but guess what? It's probably higher than that. Now, the Fed, the FOMC, the Federal Open Market Committee, the arm of the Fed that decides on whether they're going to raise interest rates or lower interest rates or keep them the same. What does the Federal Reserve do with this information that we just got on the jobs report? Well, the Fed's big meeting of the FOMC is coming up here in mid-September, just a couple of weeks or less, right? And the market, the stock market right now is betting heavily that the Fed is going to cut rates. I believe that the Fed is going to cut rates as well, at least 25 basis points, right? It could be even higher than that. They might cut rates 50 basis points. Now, 25 basis points, that's a quarter of a percentage. A 50 basis points cut is a half a point or a half a percentage. But here's my critique of the Fed. Let me just put it out there, okay? In my opinion, the Fed has been too data driven. Every time you hear the Fed talk nowadays, what are they saying? They're always saying, well, we're looking at all the data, right? It's always saying that they're data driven and we're going to rely on the data to make decisions. But that sounds good. But here's the problem with relying on the data. The data is always lagging behind, right? The data is always yesterday's news being reported today. So if we have a Fed who is relying on the data, then guess what's going to happen, guys? They're going to be behind, which we keep seeing with the Fed in terms of being behind on major moves. Look, a Fed that only reacts to the data is a Fed that's always going to be behind and always going to be reacting. Think about it. Last year, right before the elections, the Fed eased up their policy even while inflation was in the threes, right? We had inflation 3.4, 3.5, 3.8, and the Fed was lowering the Fed funds rate even while that inflation was still higher than what it is right now. Now, here we are with inflation being sticky at about 2.8, 2.9%, maybe close to 2.5%, but the Fed has kept policy tight while the labor market continues to weaken. Now, in my opinion, what we need is a Fed that is more forward-looking, not just reacting and relying solely on the data, which I think this Fed does. And keep this in mind, we've got a new Fed chair coming next year. Now, that leadership change could completely reshape how the monetary policy is approached. And you may be saying, well, there's a lot of people on the FOMC, Federal Open Market Committee, not just the Fed chair, Jerome Powell. Well, traditionally, the Fed chair, whoever it is, they hold a lot of weight. They have a lot of pull in terms of how the other FOMC members on that committee vote, right? So when we change the chair in a year or less than a year, we may see some changes in that overall policy. We'll see. The question is this: will the new Fed chair finally be a Fed chair who is looking ahead instead of playing catch up and always so data driven? Now, let's talk about the stock market reaction real quick. Just from a couple of days ago. How did the stock market react the day that the jobs report came out and showed that we only had an additional 22,000 non-farm jobs created in August? What happened with the stock market? Stocks initially recorded some record highs right after that report, right? Because the stock market reacted to the fact that the Federal Reserve may now cut rates, maybe even by 50 basis points. However, later in the day, on Friday, those gains started fading away as concerns grew that the rate cuts alone may not be sufficient to revive some growth and to make some dents and changes in the next labor reports, right? So here's the deal. I don't like to leave a video without giving you some things to do and things to think about as a consumer and as an investor. So what should we be doing right now? Now, let's bring this thing home to our own households. One, strengthen your emergency fund. With layoffs, look, I cannot stress this enough. With layoffs rising, right? We see layoffs rising. We can't just sort of turn our back to that. Cash is going to be a safety net. If you can, you need to build up at least 6 months worth of your living expenses. If you can, right? I always say 3 to 6 months. Look, right now, you might be thinking more on the 6 months. If you want to be extra cautious, 7 or 8 months, especially if you work in a field where potential layoffs are all around you, right? You're in the tech field. Or you're in another field where you've seen people getting laid off. Maybe you work for the federal government, right? We used to not say that. We used to say the federal government work is solid. You're not going to get laid off, but we can't say that anymore. You need to be making sure you have enough money to hold you and act as a safety net for you. The second thing you want to do is make sure you diversify what's coming in so you're not taking the big risk of relying on one income stream. Listen, as much as you think your job is safe, your job ain't safe, right? There's no job that's safe. Don't rely on a paycheck only. Build out that side hustle, that side gig, that thing that you've been doing for free on the side. Start learning how to make some money and monetize that thing. If it's a small business, great. If it's some type of investment income where you're getting some dividends, great. But you need to look at other streams of income to save you in case something goes wrong with your job. Another thing you want to do is pay down some bad debt. Job uncertainty, it makes carrying debt more risky. So reduce your debt, primarily your bad debt on anything that's going down in value. Reduce that while you can, while you're getting a steady stream of income in terms of your job. And then always invest cautiously, right? Think about risk when you invest. Don't just invest willy-nilly. Be measuring the risk that you're taking by such investments, and continue to invest consistently. Stay in the game. Don't be a person that's hopping in and hopping out of the stock market, trying to guess and gamble and figure, well, I think if I take it out now like Warren Buffett, then I'm going to save up money and I'm going to put it back in. Look, you probably don't have the time that it takes to be that good with investing. Stay in the game. Continue to dollar cost average. Lean into broader, diversified index funds and ETFs. Rather than trying to speculate, read 10Qs and 10Ks and maybe get in this and maybe get in that and try to figure out what the earnings report. Listen, maybe you just want to get into index funds and ETFs, right? To keep it safer. You're still very diversified because remember, ETFs and index funds are a bucket of stocks. And so just by investing in one index fund, you've now invested in a whole bunch of stocks in that bucket. The other thing is this, you want to sharpen your skills. Sharpen your skills. You need to make sure you have a skill that can pay you, right? Shifting labor markets rewards the people who are prepared. So you want to be prepared. Up your skills with valuable, useful skills. And then also, you want to strengthen your connections, guys. You also want to network. Build your network and strengthen your network. These are just moves that are going to help you navigate this moment of job market uncertainty intelligently, strategically, with intention. You don't want to be the person that's not thinking ahead of time and not prepared. Don't wait, right? No matter what the Fed, the job market, or the stock market decides to do next, you can't control it. You can only control what you can control. And the things I'm giving you to do are things that you can actually do, right? You don't have to wait on somebody else or wait and see what the next job market report is or wait to see what the Fed is going to do. Get prepared now. Again, don't wait. Here's what we're all going to need to keep an eye on over the next week or two. Hear me out. Fresh inflation data, the CPI and the PPI are coming out. They're going to tell us if prices are sticky, right? Whether inflation is going up or down. And watch out for the consumer sentiment numbers that are coming out of Michigan. Those are going to reveal how people are really feeling about their money right now. And watch out for the Fed's beige book that shows what businesses are saying on the ground, right? On top of that, you also want to check out the market's betting odds. Right now, Wall Street, as I said earlier, is pricing in, first of all, that the Fed will do a September rate cut. I think it's a 90% chance that the Fed is going to cut the Fed funds rate by 25 basis points and maybe even 50 basis points. We'll see. But right now, the market has already priced in the fact that the Fed, because remember, the market, unlike the Fed, who's looking at data that's old and lags behind, the actual stock market is always looking forward. Right? So the stock market we see today has already priced in a 90% probability that the Fed is going to cut the Fed funds rate by 25 basis points. In other words, what I'm telling you is don't just focus on the headlines, right? The next 2 weeks are going to set the stage for what the Fed is going to do. And that decision, what the Fed is going to do in terms of keeping rates the same or lowering the Fed funds rate, is going to ripple through your mortgage. It's going to ripple through your credit cards and your investments. Now look, if you got value from this video, do me a favor, smash that like button, share this video with somebody you know, and drop a comment below. Now, I just mentioned a few minutes ago, making sure your emergency money was saved up, 6 months or more. If you want to know 10 low-risk investments to park your money right now and grow it, that's better than a savings account, do me a favor, check out this video right here next. Peace.